Just 20 seconds to go until the start of cash equities trading, and futures have been pointing decidedly to the upside, and they continue to do so. So Euro Stoxx 50 futures point higher. As I said before the break, it's a couple of US themes that really on a global level have captured investors' attention over the past 24 hours or so, and that has to do with the rollout of the vaccine in the United States and the success it is having, and indeed the expectations now of fiscal stimulus in the United States. That conversation is still ongoing, of course, not counting on anything until it's delivered, but certainly it is front and center for investors. So in terms of where these European equity markets open up, and up is the right word, we open up by around 0.2% on the FTSE 100 right now. The IBEX over in Spain up by 0.6%. So we're waiting for a number of big companies that we've been following this morning to get into their stride. I can see the BP is open already. That'll be a bit of a wait in London because that stock down by 2.7% out of the gates this morning. We also talked about keeping an eye on some of the healthcare companies in Germany. They are yet to open, so we'll certainly bring you an opening price on some of those when we get them. Also keeping an eye on the silver mining companies that were doing so well this time yesterday. The likes of Fresnillo, for example, currently down by just over 2% as a result of that big bounce in silver prices and silver share prices in yesterday's session. We're unwinding both of those just a little bit this morning. So European equity markets open higher. That is amid renewed hopes for stimulus and receding concerns about volatile retail trading, with silver falling from an 8-year high. Joining us now is Ben Gutteridge, Invesco EMEA Director of Model Portfolio Services. Ben, good to speak to you. So fiscal stimulus in the US is something that seems to have captured investors' attention over the past 24 hours, Ben. What are your expectations there? How much is that playing into your strategy at this point?
Well, I mean, it certainly is playing into our strategy. And of course, these things ebb and flow in terms of the dominance in the headlines. But of course, it's been a pretty pronounced theme since the Georgia state result. Of course, there is much hope from the Biden administration that they can get something across the line with the support of the Republicans, a bipartisan deal. But if the figure isn't enough for the Democrats, then I think they'll change strategy and simply opt for this sort of reconciliation approach, which needs some offsets, but would still deliver the scale of stimulus that the Democratic Party are after and would largely satisfy some of the more progressive elements. So, yes, we're very positive about fiscal stimulus, and I'm pretty confident it'll get done. And that really sort of is a support to equity markets and seems to be gathering much attention today.
And so that is one of the supports for markets today. Another focus for investors is really around the earnings season, isn't it, Ben? What are your early takeaways from what we've seen so far? I guess the amount of visibility that is available to executives in different sectors will be a focus.
Yeah, I mean, short-term earnings is a challenging one always. I think we would always come from it on the expectation that actually beating expectations is probably the standard expectation. You typically get about sort of 65 to 70% of earnings surprising to the upside. So in the short term, you know, from some of these big businesses, you know, if they're missing, it's sort of a double disappointment. In the expectation is almost that you do beat expectations. So yeah, a miss could be quite punishing. But we've seen some of the bigger tech businesses or tech-related high growth businesses, you know, Apple, Visa, Mastercard, you know, put in some impressive numbers. So in the short term, although it's not quite our game, actually earnings season being fed reasonably well.
And in terms of the tech sector, which you mentioned there, you also mentioned in your notes ahead of this conversation that the Biden administration may go a little easier than some think on the tech sector. Where do you see that playing out?
Well, I think, clearly the social media platforms have been far more generous in the platform that they've given the sort of centre-left wing of politics relative to those on the right, working much harder to shut down those portions of politics. And so that has been played into the hands of the Democrats. So that curries favour, of course. But we do recognise there's concerns about sort of data protection. So we would expect the Democrats to work towards putting tighter regulation on that. But of more concern to the tech sector, I think, is really valuations. And a very large fiscal stimulus, a pro-growth policy, has much more of a reflationary drive to it. And that really would work against tech valuations. So that particular narrative, actually, even though I don't expect the tech sector to be punished as maybe some do on a regulatory level, actually the bigger challenge comes from the potential growth recovery that comes from not only the fiscal stimulus but from vaccine rollout.
Okay, so it isn't necessarily the regulatory challenge. It's the fact that they'll face rivalry for investors' dollars from growth stocks. Which of the growth stocks or growth sectors have you got your eye on at the moment, Ben?
Well, I mean, our starting position, so apologies, there's some sort of subtlety to this, but I'm sure viewers will get it. But our starting position is we're overweight those sort of growth, high quality sectors, recognising there'll be recovery, but not expecting some of these secular trends to mean revert in any great shape. The online shopping, e-commerce, digitalisation. But at the margin, if we do believe in this sort of growth recovery built on vaccine rollout, built on fiscal stimulus, then the move towards more value sectors, industrials, bit of financials, maybe some retail. That is where the sort of the marginal move is made. A high conviction view is we really like equities, a lower conviction view on which styles, but moving away from high quality growth towards value.
Okay, and we'll pick up exactly there in our next conversation, Ben, because we want to talk about vaccine rollouts and the impact of that. Ben Guthridge, Invesco EMEA Director of Model Portfolio Services, stays with us on the programme. Thank you for your thoughts so far. 6 minutes past 8 here in London. Coming up on the programme, Merkel's vaccine pledge. The German Chancellor promises all citizens a first shot of the vaccine by the end of September. We'll get the latest on the vaccine rollout in the EU, in Germany and beyond. This is Bloomberg.
Zweitens, die Europäische Union hat sich nicht für Notzulassungen entschieden.
The European Union decided against an emergency authorization. We know, for instance, that the UK approved AstraZeneca in 24 hours. I think that for good reasons, namely trust concerns, the European Union decided to go for a provisional approval, and this isn't an emergency approval and thus has a different quality to it.
That was the German Chancellor Angela Merkel explaining why the EU has been slower to approve coronavirus vaccines. She's also promised all Germans their first injection by the end of September, as long as drug makers stick to their delivery commitments. Meanwhile, European Commission President Ursula von der Leyen tried to deflect blame for a controversial plan to control vaccine exports from the EU into Northern Ireland, saying Trade Chief Valdis Dombrovskis had been responsible for the decision, or at least her team said so. Let's get on this broader point about vaccine rollout. Let's get to Ben Gutteridge, Invesco EMEA Director of Model Portfolio Services, still with us. And Ben, it's really interesting. I see different pieces of research on the subject of the slowness of vaccine rollout in the EU. And some say, come on, it's only February. There's still time to make this up. You know, this is a long distance race. It's not a sprint. And others say there are going to be clear ramifications, either health-wise or politically, from these early delays. What's your take on this?
Well, I mean, clearly it's not been a good few days for the European Union. I mean, it's absolute fodder, isn't it, for the Eurosceptics? But I think I would take some sympathy with some of the earlier comments you were referencing, that actually the timing, whilst extremely frustrating, I'm sure, for many Europeans and sad, of course, it is sort of a natural feature of manufacturing and supply disruption, especially for such a new project and something that is being accelerated so fast. But, you know, I think there's great confidence that these supply-related issues can be resolved in the coming months. And I think as investors, I think actually, you know, we can look through that and believe it shouldn't really disrupt the recovery in any great way. Of course, the political ramifications, you know, at the margin aren't particularly helpful, but it's not obvious that there is a sweeping amount of Euroscepticism pressurising leadership at the moment in Europe. So I think on both fronts we're feeling sort of observing it in a rather benign fashion.
Right, and you talked about, in terms of how this plays out then into investment strategy, you talked a little bit about how at the margins, it was the industrials, the financials, the more growth side of things where you were looking to make up some ground, Ben. What kind of time horizon are you looking at then when you're putting together these portfolios at this point? When you think about vaccine rollout, what assumptions are you making about rollout and what that does to your portfolio?
Well, it's a gradual move away from the higher quality growth businesses into the value sectors, and I think weakness is the opportunity to start to make those moves. It's clear that the very high levels of infection that we have and the speed of mutations relative to the speed of vaccine rollout is going to create some uncertainty and some unease in markets, that actually the pace of recovery, the pace of reopening is going to be thwarted. And no doubt that will be sort of a feature of the news over the coming months. And so the weakness that expels on markets, we think, is the opportunity to transition away from those higher growth businesses into those value sectors. And we think those opportunities will present.
And clearly you try to focus on these more longer-term themes, or medium-term themes at least, Ben. But in terms of the short-term, markets have been very preoccupied by this boom in retail investor interest. Many people are sort of quite conflicted in how they feel about this. Pleased to see more retail investors, more young investors getting involved in markets. Suspicious perhaps about some of the activity going on behind the scenes. And also maybe nervous as about regulation to come. How do you contextualise what you've seen over the last week and a half?
Well, I mean, yeah, of course, it's great to see people investing, but we would always encourage, you know, seeking out advice. There's some pretty volatile stocks people are chasing here, and depending on their financial position, this is, you know, could be a really problematic strategy for them. I think what we've got here is clearly a feature of extremely accommodative monetary policy, is an additional symptom of extremely accommodative monetary policy, which we do not think is about to be reversed at any moment. Indeed, the most recent comments from the Fed chair suggest these types of events really aren't disrupting their thought processes, and the idea of a taper really isn't an imminent prospect. So that is sort of, I guess, a bit of fuel to that type of speculation, and does support the valuations of smaller caps, of more speculative areas, and indeed highly valued businesses where there is considered to be some sort of bubbly type valuation as it stands. So in the absence of a tighter monetary policy, it's still well worth in your portfolios, having exposure to some of those highly rated businesses, because that's where the retail money may well flow.
Okay, thanks very much. Thanks for your time, Ben, this morning. Really good to speak to you. Ben Guthridge, Invesco EMEA Director of Model Portfolio Services. Ben will continue his conversation with me at 9 a.m. UK time on Bloomberg Radio. That's where I'll be heading after this TV show, so in 45 minutes' time. We were talking there with Ben about the rollout of vaccines, and let's get an update on how that is going across Europe. We're joined now from Brussels by our colleague Maria Tadeo, who's got details on the political battle here as well. Ursula von der Leyen then having to weather the storm around vaccine fallout. Maria, how is she doing?
Well, not great this morning, and pretty much on a media blitz across all European newspapers. And this was an interview that I understand that was organized yesterday pretty much out of the blue by her team that decided to call up the correspondents from big newspapers because she wanted to send a message to all the European capitals. She's coming under pressure over the AstraZeneca fallout for taking an offer that many still believe is not good enough. She's also taken heat for not taking responsibility. Essentially, that's what it is, Anna. Many do criticize that she doesn't fully get the implications of the job that she has, the situation that happened on Friday that could have triggered a diplomatic incident on the Irish border, too. That's something that some still believe she should have taken responsibility for that. Instead, there's this idea that she's almost trying to deflect everything away from her, and also just this perennial criticism that when it comes to Ursula von der Leyen, there's not a lot of scrutiny over what she does or says because we never see her. She never tends to speak to the press. Whenever she does, she likes to do it in a way that's very controlled by her, and all of this is now coming to some extent to boiling point because of the AstraZeneca situation.
And how, in terms of the rollout of vaccine, how does Europe get to 70% vaccination, given how slow the process is? And we've heard these targets from Germany this morning. How do we get there? We have to speed things up, I suppose.
Well, and her message this morning, and to some extent she's lucky that Angela Merkel, who is still very much the Chancellor of Germany and still very much in power, is repeating the same line, so that's offering her a lifeline for all we know. But the two are saying by the time we get to summer, there will be herd immunity because the numbers that we see right now do not really reflect the pace that we can get to when we have more vaccines approved, when we get mass distribution, when we scale up, and when we're able to do this to a mass public. The early stages were always going to be difficult, but we know that this is going to speed up. To some extent, Anna, what I would note is that right now in Europe, we're seeing from a number of names from Novartis, Sanofi, also Bayern jumping on this, making vaccines from rivals to scale up. So it does seem that the effort is heading into that way too. If there's any partnerships that can help to big up the numbers, then that's the way to go. But again, if you look at the numbers that we have right now, it does seem that we're a long way away from 70%, but that is a number that will make, to some extent, Ursula von der Leyen make or fall. If she gets to 70%, you could argue that a lot of this will be forgiven.
Right, yeah, these things can start slowly and they can speed up and political fortunes can recover. We will watch to see what happens. Bloomberg's Maria Tadeo, thank you very much for joining us. Let's take a look at some of the movers we've got for you this morning. 18 minutes into the European trading day. We've got Fresenius Medical is one of those businesses in focus. That particular business down by 13.4%. We've seen full year profits decline there. Some of the guidance perhaps from the company falling a little short of some expectations as well. BP down by 1.9%. Earnings again in question. Also cash generation and the trading operations at BP. We talked to the CEO about some of that, all of that happening during a period of huge flux for the business. Moonpig, this is a gift company and it has IPO'd in London, and you can see the result of that IPO. The stock is up by 22.7%. Coming up on the programme, retail mania loses momentum as GameStop slides on low volume and silver futures slide from an 8-year high. We'll get the latest in the Reddit-driven short squeeze. This is Bloomberg. remarks for the business. Reddit-driven. Welcome back to the European Market Open. 21 minutes into your European trading session for this Tuesday morning. You can see European stocks doing pretty well, up by 1%. Basic resources up by 0.8%. So we see that sector once again doing well, despite the fact that today looks very different on silver. We saw mining being pushed higher because of the silver price going higher yesterday. Today, silver retreats, but still mining stocks in general are moving to the upside. Now, amid the Reddit-fueled market mania, attention has turned to highly shorted companies and, of course, those who short them. We spoke to one of the world's best-known short sellers. We asked Carson Block if he thought regulators might uncover misconduct.
This, to me, doesn't seem like it's a legal issue. Now, to me, what might be more interesting, because I talked about how we were short GSX, and that seemed like an engineered squeeze by some hedge funds. So, if anything, some very smart, sophisticated hedge funds have been playing the squeeze game for a while. And it's kind of like the same ones, I think, end up getting into these squeezy names, and boom, it squeezes.
Well, hang on. Do you think that it was hedge funds squeezing out Maple Lane and Melvin and left of Citron, or do you think it was day traders on Reddit?
Initially, no, but the point that I'm making is that this is effectively what happened with GameStop, et cetera, was a democratization of this tactic. And I have wondered, especially as we're getting squeezed on GSX, I have wondered, like, is there coordination there with these hedge funds? So what wouldn't surprise me, I mean, I don't think you can look at, the Reddit message boards and people saying, like, I'm going to buy calls and I'm going to buy calls, and say that's coordinated trading to the extent that it rises to manipulation. But maybe where that, some attempts to poke at that go are, looking at the hedge funds that have been employing this tactic for some time and really asking, well,
Carson,
okay, what constitutes coordination? Did they cross the line? Carson, that could be interesting.
That was Carson Block, the CEO of Muddy Waters Capital, speaking there to our colleague Eric Schatzker. Let's stick with this theme because GameStop continued its fall after hours yesterday, following a 30% plunge during normal market hours. So has the GameStop trade finally been stopped? Joining us now to discuss is Bloomberg's Danny Berger. Danny, morning again. So have the shorts now been washed out of the market? Is that what we see here?
And to a large degree, yes. We have short interest fall pretty dramatically. You'll recall that at a peak, about 140% of shares were shorted. So that's when you have a situation when shares that are borrowed to short are borrowed yet again, allowing us to get above 100% of shares floated. That now has dropped, according to S3, to about 50%. That's if you include those sort of synthetic longs that occur when you borrow multiple times. If you exclude those, that's more about 30%. But look, 30%, 50%, these numbers are still pretty elevated for your average stock in terms of short interest. So there still are more short positions that could be washed out of the market. And we could see more shorts put on. Now, one of the key measures when looking at how many people are shorting, how much demand there is the cost of financing shorts. And this got really expensive. In other words, because so many people were either shorting this stock or they were holding on, not selling, be it the diehard Reddit crowd or just index funds who couldn't sell, it was really expensive to try to borrow a stock in order to do this. But look at those costs fallen dramatically now, Anna.
Yeah, absolutely. And interesting to Robinhood and the role it's played in all of this then, Danny. When we heard from the CEO, of course, of Robinhood, he was very much saying that the limits they put on individual investors were to do with their own financial position. And now we learn that they're raising money, $2.4 billion. How much trouble is this business in at the moment?
So in terms of just their capital position, because they've raised money, they seem more secure in that regard. But it just does show that costs at Robinhood, especially company that wants to go public this year, are set to rise, be it on making sure they have the collateral or dealing with their customer service. There might be more money this company needs to spend in order to grow. People familiar do tell us that Robinhood still has its IPO planned for this year, or it might look at something like a SPAC in order to go public. But part of the interesting thing is about the money they've raised. So 2.4 announced yesterday, plus an additional $1 billion. The way that this works is that they convert into equity. So should the company go public, these will be worth at least 30%. So that could pressure them. Question will also be, will they continue their payment of order flow? This company here has discontinued it. Will Robinhood? It's a large chunk of the money they earn, Anna.
Yeah, interesting stuff. Danny, thank you very much. Danny Berger on the markets. Now, the CEO of BP tells this program that shareholders are supportive of the company's transition strategy. Shares of the oil major dropped this morning. We will talk about the energy businesses. This is Bloomberg. back to the European market open. 30 minutes then into a trading session that looks broadly positive, lifted by vaccine rollouts in the US and expectations of fiscal stimulus. You see the FTSE, the DAX and the CAC all moving to the upside. In terms of sector breakdown then, this time yesterday we saw that some of the mining stocks were doing very well on the back of the silver price. Mining companies now not far from the bottom of the list, if you like, but all sectors in positive territory, including the mining sector up by 0.5%. So all of these ships being lifted by these same themes. Very much to the top side, though, autos and auto parts. That is the best gaining sector. Travel and leisure also follows behind. So some of the most beaten up sectors during the pandemic moving to the upside in today's trading session. Let's get a Bloomberg First Word News update. Here's Laura Wright.
Thanks, Anna. German Chancellor Angela Merkel is reiterating that all Germans will be able to get a vaccine by the end of September, as long as drug makers stick to their commitments. Even if new shots are not approved, she says Europe's largest economy should have enough supplies. Merkel has come under fire after pushing for the EU to take the lead on procuring vaccines. President Joe Biden has held stimulus talks with Senate Republicans that one of them described as very productive. But the president's press secretary says he intends to continue pushing for a larger relief bill and will bypass the GOP if he needs to. President Biden's plan is for a $1.9 trillion package. The Republicans want just $618 billion. President Joe Biden says the U.S. could reinstate sanctions on Myanmar if the military doesn't give up power. It seized control in a coup yesterday morning, detaining government officials, including the country's de facto leader, Aung San Suu Kyi. The U.S. is calling for their release, saying any moves away from democracy will result in new restrictions. New York and the northeastern U.S. states are facing their heaviest snowstorm of the winter so far. While the brunt of the storm is easing, it's expecting to drop several more inches overnight. If the forecast holds, the storm will earn a spot in the top 10 worst storms to hit New York City in data going back to 1869. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Thanks very much, Laura. It makes me feel chilly just looking at those pictures. Thanks very much. Let's turn to ESG investing and the role of the oil giants as the global shift from fossil fuel to greener energies gains momentum. The BP CEO Bernard Looney told us earlier that investors are supportive of the company's strategy to make itself more climate friendly.
Share prices are down across the entire sector, and that's because of COVID. Now that we've got vaccines, they're being rolled out, things are looking better, and our share price is probably up 40 or 50% from the lows of last year. Secondly, as regards the strategy, I think the shareholders they're very supportive, and I think if anything, Anna, over the holidays, I think there's sort of a growing strengthening around the belief in the strategy.
But BP shares are trading weaker this morning, as for some investors, this is little comfort if they're looking for further return of cash or quicker return of cash. It has been a brutal year for the sector, and the fourth quarter wasn't much better, with adjusted net income at BP of $115 million, a far cry from $2.5 billion a year earlier. Joining us now to look more broadly at the pivot that we're seeing from businesses such as this into lower carbon intensity is Bruce Stogood, who's Federated Hermes International Head of Stewardship. Bruce, good to speak to you this morning. Let me start on something around the oil sector, if I can, and then we'll sort of broaden the conversation around what you're doing in terms of this stewardship dynamic. So a company like BP clearly setting out its stall at the forefront, perhaps, of this particular sector in the pivot away from big oil into other greener energies. How would you rank BP against its peers?
Yes, good morning, Anna. And BP was the first of the oil majors to announce a net zero strategy. And this was a welcome response to the questions from investors to clarify its strategy, because we wanted to see a strategy consistent with the Paris goals and to make very clear what that investor proposition was. And Bernard Looney responded emphatically to that when he took up his role as CEO and has laid out a clear strategy that involves a big shift to low carbon energies and a reduction in the exposure to oil and gas, 40% by the end of this decade. And so investors do know now what to expect from BP, how they will deliver on the Paris goals. And it is then about implementation for the company, demonstrating that they can actually carry out this major transition.
And Bruce, how do companies in this sector navigate this complex transition, in the sense that in the short term, many investors will still be asking for returns. They'll still be asking for cash to be generated, and they'll be looking at the pivot that the company's making and saying, you're going into parts of the energy spectrum that maybe are a little bit less profitable than oil and gas. And there might be concerns around that. Other investors might be maybe in it for the longer haul and very much in favor of the pivot that's being undertaken here. Is BP, like many other businesses in this space, having to talk to different types of investors here?
So you're right that the return profile on renewables tends to be lower for each project, but on average over the long term it could be as good or higher, depending on the volatility that you might see and the perspective on the long-term future of oil and gas. And in a scenario where we are heading to net zero, then that reducing demand for oil and gas is going to mean structurally lower oil and gas prices over the long term, and therefore lower returns than would otherwise be expected. And so I think that transition, it can be managed well and can deliver good returns on investment. But in the short term, the increase in capital can mean that you don't have the cash immediately to give back as dividends, and so you see that reduction in dividends taking place at some companies.
Yeah, so that's the short-term challenge. Let me ask you about the new engagement plan that you've launched, a 3-year, I think, engagement plan. Tell me what that aims to do. Who are you trying to engage with?
Yes, so we engage with companies on behalf of our clients, representing $1.2 trillion of assets. They're long-term investors. So what they're looking for is sustainable wealth creation. That's really good returns on investments, but also positive outcomes for society and the economy in which those investments sit. And so we're focused on the issues that will drive the long-term values of companies. So that's climate change, getting to net zero, but also human rights in the supply chain, modern slavery, digital human rights, managing the staff of the company, the most valuable asset for most companies, and also avoiding the next crisis. So climate change is one of those, but so also is biodiversity and the loss of species, and also avoiding antimicrobial resistance, which could be 5 times worse than the coronavirus pandemic has been.
Bruce, how do you go about identifying or separating out businesses that genuinely want to launch new commitments and set new directions, and other businesses that maybe want to pay lip service to that because it makes good PR, but their heart's not in it? Is it looking at the lobbying, the political lobbying activities that those businesses actually do behind the scenes? Is that what gives you the real insight?
Well, that's certainly one of the dimensions. But what we have to look at very carefully is the performance of a company across a range of different dimensions to see the quality of their plans to achieve ambitious goals. So you see this in climate change as a good example, where last year there was a tripling in the number of companies making net zero pledges. But not many of those companies have laid out detailed plans. What we want to see is short, medium, long-term targets, capital expenditure that's aligned to achieving those goals. You're right on political lobbying, that should be aligned and transparent to the strategy, and then good governance to oversee this, and good reporting, transparently using the Task Force for Climate-Related Financial Disclosures. When you see that whole package, then we can believe that this is a credible plan. There's going to be significant benchmarking of companies this year against the Climate Action 100 collaborative engagement, and that will give us a readout of just how well different companies are actually planning for the transition.
Bruce, thanks very much for joining us. Bruce Duguid, Federated Hermes International Head of Stewardship. Thanks for joining us. It is 8:39 here in London, 9:39 if you're in Paris or Berlin. Up next here on the European Market Open, we'll bring you Money Undercover. I'll look at the private equity world. Danny Berger will be here speaking to Rebecca Gibson from Oakley Capital. This is Bloomberg. to the European market open here on Bloomberg TV. 42 minutes into a positive session. Stocks in Europe up by 0.9%. Some of the most beaten up sectors then. Autos doing very well this morning. The auto sector up by more than 2.4% here in Europe. We're also focused on technology because, of course, we are expecting a lot of technology companies to report a little bit later on today. Amazon and Alphabet, certainly after hours. Now, for all the frenzy happening in public markets, private equity is having a frenzy of its own. The value of PE deals soared last year with $612 billion worth of acquisitions. That's up more than 6% from a year earlier. And the pace of deal making has only continued to pick up speed. Here with a guest to discuss the latest in the sector is Danny Berger. Danny.
Anna, thanks so much. I'm thrilled to say that joining us again is Rebecca Gibson, a partner at Oakley Capital. Rebecca, first off, thank you so much. And I know it's been almost a year since you were last here, and it's a completely different environment now in markets, especially with, as Anna mentioned, this frenzy going on in retail. Private equity, though, has largely been immune to that. Though, do you think the industry needs to be doing more in allowing access to investors like retail investors?
Absolutely, and I think retail investors are attracted by the very consistent returns that the private equity industry has been able to deliver. But as we've spoken about, the industry does have limitations for private investors given the long-term commitment nature of a private equity commitment. So the best way to access it is via listed investment funds. And actually, Oakley has always had a listed investment trust, OCI, as a key part of its investor base. So we've always welcomed retail investors who want to participate in the success the Oakley Capital funds and be able to track a private equity profile. They can easily go and buy OCI shares on the stock market.
In looking at your listed vehicle, though, and comparing it to what's been happening in, shares in GameStop and that kind of thing, does that get you and maybe other people in the private industry, equity industry, nervous about having a retail base that they can cause more volatility?
I think a lot of it's about communication and transparency, and we've in recent years been really working to make sure the underlying investor base really understands how the private equity model works. And what you're looking with a lot of the volatility is views on particular business models. Within the private equity funds at Oakley, you've got a varied number of portfolio companies with a number of very common investment strategies and a clear track record of success. Unfortunately for us, those investment strategies have played out very well in the current climate, given it's a lot of tech-focused and tech-enabled digital businesses. So we've been able to demonstrate the consistency of that performance, the increasing shift to digitalization, and the benefit of subscription-type business models. So for us, that communication with the retail investor base, as with all our investors, means we hope that that transparency enables them to value the shares in the right way.
Let's talk a little bit about that strategy then. So you last week announced a new fund round closing about 455 million euros. How competitive is it going to be for you to deploy that capital given just the deal flow we're seeing at the moment?
Yeah, I mean, competition is a theme we've spoken about over many years. There is a lot of capital in the market, and amazingly, during the period during the crisis of COVID, there's actually been no respite in the amount of capital being raised. And as you said, we were very fortunate to benefit from that. But what you saw was a real flight to quality managers and tried and tested managers. So investors are putting their capital behind the strategies and business models that they understand and feel will thrive in the current climate. And part of that is about how you can play into the competitive nature of that market. At Oakley, we do that by playing to our entrepreneur network. Over the last 15 years, we've built up a deep network of founder managers and entrepreneurs who typically want to work with us earlier on in the development of their businesses. These are established businesses. We're still very much working hand in glove with those management teams. And for them, that relationship is often about much more than price. It's about cultivating that relationship over years and also demonstrating the success of our sector knowledge and expertise through the other portfolio companies we have.
Right. It might not be about price, but surely valuations come in factor pretty large here. I mean, what do they look like, especially as you say those more quality names that a lot of people are flocking to right now?
Yeah, you've seen that the pace of deal activity, as you commented with the statistics, has not let off. And actually, we did 8 deals last year, which if we'd sat here and looked ahead to 2 months of lockdown, you'd have thought would be remarkable. So what you are seeing is processes where, for us at Oakley, it's typically relationships we built up over a longer period of time, and you're being working with those management teams to think about how to create value. And ultimately, the management teams we're working with, when you're going into a deal at a stage where they're remaining in as significant partners alongside you, it's as much about the value creation that you can achieve together as it is about the day one price. So that for us is very important, demonstrating that we can do add-on strategies, go out there, buy a platform, but then add on with additional acquisitions. And that's been a feature of the market that has been very strong. So over 2/3 of the M&A last year was actually add-ons to existing platforms. So those funds with good platforms
Rebecca,
which are performing well had a real advantage being able to go out there.
Rebecca, what about UK-specific deals? There's a lot of thought there that the UK, come March, they're going to be changing capital gains tax laws in terms of taking away some of the relief there. Are you seeing any impact in terms of businesses being sold? Is there a rush right now to get your business sold before you'll all of a sudden face more taxes come March?
Look, whenever there's a change in government policy or regulation, and particularly tax, then that does create a dislocation and an opportunity. So certainly that is the situation right now. And we've been having conversations with a number of those founders and management teams for a long time now. And actually, we found COVID was quite a catalyst for many of them, where they'd been reluctant to think about selling control or bringing on a partner. But having gone through the pandemic, they recognize the value of de-risking and bringing along an institutional partner that can add value. And the tax change is another catalyst in that decision. More broadly, I think we're all hoping that the government will continue to inspire and bring on further entrepreneurship in the country, because that's what can be needed to bring us out of restore the country to growth.
Right, so do you think this will have a big impact then to discourage entrepreneurs if they don't get any sort of relief when they sell their business?
I'm sure the government will put in policies in place to make sure that entrepreneurship is encouraged, because it's been such a lifeblood of the economy. And what you're seeing at the moment is a short period of activity. But if you have a great manager with a good business, they're not just going to cash out now if they feel there's longer term value still available by holding on.
Right. Rebecca, I'm afraid we're going to have to leave it there. Rebecca Gibson, partner at Oakley Capital, thank you so much. Anna, that's one thing for us to look out for, that March budget, to see whether or not we'll indeed get those capital tax gains raised and what effect that will have on deal flow.
Yeah, absolutely. Something to focus on, certainly in the UK, with the forthcoming budget in mind. Danny Berger, thank you very much for that. Danny Berger with the latest Money Undercover conversation there. Just want to bring you one headline that caught our attention whilst Danny was conducting that interview, and that comes from Elon Musk. He's just put out a tweet that just says, off Twitter for a while. Doesn't say any more than that. Off Twitter for a while. We'll keep an eye on his Twitter feed, nonetheless, in case he decides to return to it. Many people, of course, have been interested to see how it is some of the things that Elon Musk talks favourably about on Twitter that then attract the attention of retail investors. So certainly something we will keep across. Coming up here on the European Market Open, what is needed to keep the dollar going? We will put that question to Laura Cooper. It's had a good run so far, the dollar in 2021, in contrast to the latter part of 2020. What is the trend from here? We'll talk to the MLive team next. This is Bloomberg. Welcome back to the European Market Open. 53 minutes into a European trading session that is broadly positive. Joining us now, Laura Cooper, Bloomberg's Markets Live macro strategist. And Laura, good morning. One of the reasons we seem to be positive is a little bit less tension being created by that relationship between retail investors and hedge funds. That forced selling as a result of covering short positions, certainly a conversation we had a lot last week. Today seems different, or this week seems a little bit different. Interesting to see Elon Musk is saying that he's going to be off Twitter for a while. I wonder if that'll have an impact. But what are you seeing in terms of that retail debate this morning?
Well, certainly we are seeing signs that this retail frenzy is starting to wane. And I think that reflects a couple of factors. One, we did have these trading constraints imposed by platforms yesterday to kind of take some of the froth off those popular retail stocks. We're also seeing kind of the risk of concentrated elevated shorts beginning to unwind, so that's less of a risk. And ultimately, I think, contagion risks remain contained. We aren't seeing this as a spillover to a broader systemic risk for the markets. So I think today we're just really seeing more of a reprieve, and we're going to shift back really to those fundamentals of earnings and potentially data. And of course, the stimulus watch continues.
Yes, indeed. I was just talking about a tweet from the richest man in the world, Elon Musk. Later on today, we're going to hear from the second richest man in the world. That is Jeff Bezos. We'll hear from Amazon, of course, reporting later. And I wonder what we're looking for when it comes to the tech earnings in terms of the broad picture here.
Well, certainly, Amazon is expected to have quite a record quarter in the final 3 months of 2020, and that's just reflective of this secular trend of this work from home environment. So, millions of people are expected to have gone to Amazon for Christmas shopping during the pandemic. So they're expected to really provide kind of upbeat reports today, in excess of $100 billion in revenue. But ultimately, I think, lofty market expectations do point to potentially disappointing price action. That's certainly what we've seen in earnings so far, is regardless of sales or profit beats, we do tend to see, stock prices come under pressure because there's a lack of really guidance. And I think markets are focusing more on that than potentially kind of those backward-looking figures.
And Laura, just briefly, the dollar started out well in 2021 in contrast to 2020. Your brief thoughts?
Well, certainly for Q1, we are seeing the dollar kind of climb back, and that's reflective of really just this U.S. growth exceptionalism continuing. We are seeing the potential for stimulus to feed through, and speculators are caught on the wrong side of that trade. So we are seeing some positioning squeeze there. But ultimately, yes, we're going to see fiscal stimulus come through, which does mean higher deficits. That does mean the Fed is going to likely continue to outpace their peers in bond purchases. So ultimately, that does still lead to dollar weakness, although some near-term reprieve from that trend.
Okay, thanks very much, Laura. Have a good session. Laura Cooper, Bloomberg Markets Live macro strategist, joining us there with the latest on the markets. That is it for the European Market Open. Surveillance will be up with you next. They'll be tracking the twists and turns in the markets, the moves to the upside this morning here in Europe. They dominate. This is Bloomberg.
Short interest in GameStop plummets, and so do shares. The silver rally also runs into a roadblock. BP earnings fall short. COVID-19 hits the oil majors' fuel sales and margins. The chief executive tells us that investors are supportive of the company's energy transition strategy. And Deutsche Bank's debt trading jump outpaces Wall Street. That's a Bloomberg scoop ahead of Thursday's results. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. There's quite a lot going on in the markets. Now, of course, the focus for the last 10 days, and a lot of people are saying it's been a fun 10 days to follow the markets, really day in, day out, and trying to understand the plumbing behind some of these short selling. And the markets today, not dull either. Now, they are, of course, changing a little bit in terms of the narrative compared to what we saw just yesterday, but global stocks are climbing on renewed hopes for stimulus. There's been progress on vaccinations. We're receding concerns about volatile retail trading. I'm also looking at silver pulling back from an 8-year high, and then a bit of support for pound given what we're seeing with the number of vaccinations and the speed at which the UK is vaccinating today. So we'll have plenty more on the markets throughout the day. I'm looking forward to our conversation with Mark Cudmore shortly, but now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. German Chancellor Angela Merkel is reiterating that all Germans will be able to get a vaccine by the end of September, as long as drug makers stick to their commitments. Even if new jabs aren't approved, she says Europe's largest economy should have enough supplies. Merkel has come under fire after pushing for the EU to take the lead on procuring vaccines. Now, President Joe Biden has held stimulus talks with Senate Republicans that one of them described as very productive. But the president's press secretary says he intends to continue pushing for a large relief bill and will bypass the GOP if he needs to. President Biden's plan for a $1.9 trillion package, the Republicans want just $618 billion. And President Joe Biden says the U.S. could reinstate sanctions on Myanmar if the military doesn't give up power. It seized control in a coup yesterday morning, detaining government officials, including the country's de facto leader, Aung San Suu Kyi. The U.S. is calling for their release, saying any moves away from democracy will result in new restrictions. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now let's get straight to our top story. And GameStop continued its fall after hours yesterday, following a 30% plunge during normal market hours. So has the GameStop trade finally been stopped? Well, joining us now to discuss all of this is Bloomberg's Danny Berger. Danny, it's been a pretty volatile, but also extremely interesting, actually, 10 days to look at the markets. Have the shorts now been washed out of the market?
It really has been absolutely fascinating. And look, it does seem like to a large degree, shorts have been exiting. Are they completely washed out? It doesn't look that way so far. So to put it in context of the figures, according to S3 Partners, 140% of shares floated at the peak were shorted. As of data that they compiled up through Monday, that figure now looks to be about 50%. If you take away some of the synthetic longs, which are caused when a share is borrowed to short and then borrowed again, so you have 2 longs for every short, more or less, that goes down to around 30%. So a lot of shorts exiting, but Francine, 30% is still pretty high compared to the typical S&P 500 or Russell 2000 stocks. So we certainly could see more pressure to cover those shorts.
Danny, we also learned that Robinhood has raised $2.4 billion. How much trouble are they actually at the moment?
So that extra capital certainly helps them in terms of, facing higher collateral, things like that. But if anything, this does show that costs at Robinhood have been rising ahead of what they had planned for a May IPO, be it costs for things like collateral or be it customer service. So this is something investors are going to have to keep in mind, because people familiar tell Bloomberg that they are still looking at an IPO, or even perhaps going public through something like a SPAC might be an option that they decide on. If anything, this episode might encourage them even more so to IPO. That's because this money that they've raised, it gets converted into equity when they do go public. So that might pressure them to finally go ahead and list, Francine.
Danny, thanks so much. Our Danny Berger there with the ins and outs of exactly what we've been witnessing in the markets. Now let's dig a little deeper with Mark Cudmore. He's our Bloomberg MLive managing editor in Singapore. Mark, first of all, congratulations on a great blog. I know it's been very fast moving, and it's been also a frenzy for market commentators just to keep up with exactly what's going on. As the dust settles a little bit, what do you think will be the main takeaway of the week that was?
I think, first of all, this dynamic isn't over. I think that's probably one of the most important takeaways. I think we're in a consolidation phase now. So GME has come off the highs, silver's come off the highs, and there's talk about what they might target next. Do they go back to certain single name stocks? Do they move into another asset class? But I think the overall theme here is that this idea of heavy retail participation in certain assets is likely to be with us for the months ahead. Maybe not to the extreme scenarios last week, because hedge funds are going to be more careful about this in future. I think that the smartest people in the market know this is a dynamic now. People are going to be more prepared for it. They're not going to leave themselves so vulnerable. I've tried to talk to as many portfolio managers as possible over the last week, and almost everyone says they're completely reassessing their whole view around holding shorts generally. It doesn't mean they don't hold shorts, but it means they'll no longer be as keen to hold shorts that they know are already consensus trades out there. So I think the consequences will be with us for some time to come.
Mark, we also spoke to Carson Block yesterday. Take a listen.
This, to me, doesn't seem like it's a legal issue. Now, to me, what might be more interesting, because I talked about how we were short GSX, and that seemed like an engineered squeeze by some hedge funds. So, if anything, some very smart, sophisticated hedge funds have been playing the squeeze game for a while. And it's kind of like the same ones, I think, end up getting into these squeezy names, and boom, it squeezes.
Well, hang on. Do you think that it was hedge funds squeezing out Maple Lane and Melvin and Andrew left of Citron, or do you think it was day traders on Reddit?
Initially, no. But the point that I'm making is that this is effectively what happened with GameStop, et cetera, was a democratization of this tactic. And I have wondered, especially as we were getting squeezed on GSX, I have wondered, like, is there coordination there with these hedge funds? So what wouldn't surprise me, I mean, I don't think you can look at, the Reddit message boards and people saying, like, I'm going to buy calls and I'm going to buy calls, and say that's coordinated trading to the extent that it rises to manipulation. But maybe where that, some attempts to poke at that go are, looking at the hedge funds that have been employing this tactic for some time, and really asking, well,
Carson,
okay, what constitutes coordination? Did they cross the line?
Carson,
that could be interesting.
Carson Block there, speaking to our Eric Schatzker. Let's get back to Mark Cudmore. Mark, I mean, this was something that we were talking about a little bit earlier. Exactly what does it mean for future short squeezes? First of all, do you draw a parallel between silver and GameStop? Because it's two wildly different markets, and actually hedge funds are also positioned completely differently.
Yeah, I draw no parallel. I think it's a real mistake to go after silver. I think, as we've seen, that can work in the very short term. But silver is a market that is massively oversupplied. It's not a market with excess shorts out there. GameStop was a market where there was 140% shorts, so therefore it was obviously ripe for a squeeze. Silver is a market where there's a lag in getting that supply to the demand, in terms of that it needs, much of the transactions require physical delivery, and that takes time to actually get that physical delivery or get it in the format that's needed. But there's plenty of silver in vaults around the world. This is not a market which is lacking supply overall. So while there can be short-term squeezes, it can't be a sustainable one. So I think that was a wrong market to move into, and there seemed to be some misleading information there, which kind of feeds into that idea. I have a lot of sympathy for Carson Block's view that, obviously Reddit was a big part of this last week, but the idea that, hedge funds just sat on the sidelines passively letting, Redditors kind of bully them out of markets just seems crazy to me. Of course, hedge funds were involved in both sides of the trade. Of course, there were certain hedge funds who were definitely going to be playing the squeeze game as well. I have no idea whether they were the main part or the minor part, but to kind of assume that it was just Main Street versus Wall Street and a binary issue is just ridiculous.
Is there anything, Mark, that regulators will look at if there's some kind of, I don't know if what Carson Block said, it feels like a big accusation if these guys are like making calls and coordinating.
I think there's a big difference between, are they involved in this trade and squeezing people in terms of like, hey, they see that this short is out there, it's very large, they buy that stock. That is a valid reason to buy a stock. The market, people are excessively short. That's just a normal fundamental reason. There's no manipulation there, there's no issue, there's no coordination. I think that if a hedge fund sees that Redditors are talking about this and gets in this trade, that's no problem at all. I think there's a very big issue if you actually think now that there's genuinely a bunch of institutions who are gathering deliberately to target a certain price at a certain time. That's a very, very different story, and I have no reason to kind of substantiate that allegation, and I'm not even sure that's exactly what Carson Block was trying to imply there. I think he's just saying that hedge funds weren't a passive part of this. So I think there's an important distinction to kind of say between hedge funds doing something illegal, and I think Carson Block was very careful to say he didn't think they was doing anything illegal, than the idea that they just were like getting bullied around by Redditors. No, there will have been some hedge funds who are buying these short stocks as well.
Crystal clear explanation from Mark Cudmore. That's why we have him on. Mark Cudmore there from our Markets Live team. Now, coming up, as a Swedish appliance maker reports profits ahead of estimates, we speak to the chief executive of Electrolux. He'll give us a good indication of what people are doing in lockdown. Jonas Samuelsson gives us his first interview of the day. And that's coming up next, and this is Bloomberg.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, Electrolux has reported fourth quarter profit that beat estimates as consumers stuck at home upgraded their appliances. Yes, we've all been guilty of that. Now, the Swedish company raised its dividend as organic revenue grew 17.5%. Well, joining us now for his first interview of the day is Jonas Samuelsson. He's the chief executive of Electrolux. Mr. Samuelsson, thank you so much for joining us. It seems that you're clearly benefiting from people staying at home, deciding that it's time to upgrade their washing machine or other white goods appliances. What happens when people get out more?
Well, I think that the trend of spending more time at home and working from home will be a long-term positive for us and for the industry. And, you know, with our focus on really driving useful innovation that helps people in their daily lives at home, as people use our products and our product categories more, we expect that to be a continued positive contribution to demand over the long run.
So are you expecting to keep on this trend even when the pandemic is over, or at least seriously abated?
Well, I think the very high demand that we've seen in the last few quarters, and we expect to see during the first half of this year, most likely will normalize as people again start to travel and eat out more. But we do see an enduring trend of, you know, working more from home, spending more time at home, and using again our appliances more frequently. And I think that's where our strategy is right and sort of spot on for that trend.
Give me a sense, Mr. Samuelson, about, what would you say your performance in the fourth quarter and full year is? Did you actually manage to also gain market share from rivals?
Yeah, our focus is to really grow sales of our more innovative, more sustainable, and premium brand products. And there we've gained market share in pretty much most of our main markets. At the same time, we've left some lower end segments that are less interesting, less profitable for us. So overall, we've gained market share where we've put our strategic focus.
I know you've mentioned capacity and component availability as a restraining factor going forward. What are the components you worry most about it, and what's the underlying reason for this?
Well, there's actually constraints, across the board, but at a high level. It needs to be recalled that we're operating at very, very high levels, and supply chains are strained, whether it's from ocean freight, logistics, steel availability, certain grades, certain electronic components. So we're seeing sort of the entire supplier network and value chain network operating at very, very high levels, and with a fair amount of constraints to meet those very high levels of consumer demand.
Is there anything that you can do to actually deal with it more directly?
Well, I think we are trying to be quite proactive, and so far we've been quite successful in again operating at a very high level. But there are these sort of natural capacity limits in the system, and I think where we're seeing that acutely right now is in container freight, for example.
Mr. Samuelson, when you look at the next 6 to 8 weeks, 6 to 7 months, how does Brexit fare compared to everything else? Do you have concerns actually getting stuff into the country?
Well, there are some backlogs in the logistics flows, but I would say honestly, in the big scheme of things, it's not a major factor for us now that the Brexit agreements are in place, and we don't have excessive duties or anything like that for our product categories. So it's a constrained situation, but that's, as we discussed, true for a lot of our business right now. But of course, it's exacerbated by the increased administration around the exit of the UK from the European Union.
Mr. Samuelson, I know the chief executive, of course, is across all the problems at all things, but you have a limited amount of time. So what are your top 3 priorities in the next 7 months?
Well, first of all, I think it is to really keep supplying our customers, our consumers. Our products are essential for daily life, and it's our responsibility to make sure that we ship them. So that's the first, and then the second, of course, to do that in a safe way. The pandemic is still ongoing, and we've been very successful to operate in a very safe way. And then thirdly is to continue to execute on our strategy, to continue to innovate in relative meaningful ways for our consumers, and doing that in a sustainable way, reducing the footprint on the planet. And I think we're doing that in a really good way, and we expect to continue to do that throughout the pandemic.
Mr. Samuelson, when you look at trade concerns and some of the things that you were putting in, that you were explaining to me as makes it maybe a little bit harder in selling goods, do you expect a new stance from the Biden administration? Will that be helpful for business?
Well, it's a little bit difficult to predict exactly, but at this point we're operating well in terms of the international flows and trade flows in and out of the U.S. So I think the constraints that we're seeing right now are not specifically policy driven. It's more a question of sort of the natural limitation to supply availability that we're seeing. So we're hopeful for strong economic policies, but that's about it for now.
Thank you so much, Jonas Samuelson there, the Electrolux Chief Executive Officer. Now, coming up, we also hear exclusively from the BP Chief Executive, Bernard Looney, after the company's earnings miss shows big oil is still suffering from the effects of the pandemic. We'll talk, of course, also on the transition to a greener economy. This is Bloomberg.
share prices are down across the entire sector, and that's because of COVID. Now that we've got vaccines, they're being rolled out, things are looking better, and our share price is probably up 40 or 50% from the lows of last year. Secondly, as regards the strategy, I think the shareholders they're very supportive, and I think if anything, Anna, over the holidays, I think there's sort of a growing strengthening around the belief in the strategy.
Well, that was the BP Chief Executive Bernard Looney speaking exclusively to our Anna Edwards about the shift to be climate friendly after the company posted earnings that actually fell short of expectations. Now let's get straight to the Bloomberg Business Flash. In London with me is Leanne Gerrans. Hi, Leanne.
Hi, Francine. Robinhood's biggest backers are ploughing money into the trading app at an unprecedented pace. Investors have poured nearly $3.5 billion into the firm in a matter of days, including $2.4 billion announced yesterday. The cash comes as Robinhood is easing restrictions on certain trades that outraged customers. Deutsche Bank is beating Wall Street with a 20% jump in debt trading. That's double the average increase of 10% at Wall Street's 5 biggest banks. Bloomberg sources say the German lender's traders raked in 1.4 billion euros in the final quarter of last year as CEO Christian Saving leans on the unit to drive growth. The pandemic is hitting oil giant BP with its fourth quarter sales falling short of expectations. It managed to eke out a modest profit, but it was just a fraction of what it made before the pandemic. Refining weighing down the company's performance, but CEO Bernard Looney is predicting better days in 2021. Carson Block of Muddy Waters, the short seller famous for targeting Chinese frauds, is recognizing familiar behavior in the rally of shares like GameStop. To him, the giant gains look less like the product of Reddit-driven retail traders and more like hedge funds targeting other hedge funds with a short squeeze.
This is effectively what happened with GameStop, et cetera, was a democratization of this tactic. And I have wondered, especially as we were getting squeezed on GSX, I have wondered, is there coordination there with these hedge funds?
And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, the focus, of course, is on the markets, not only GameStop, but silver. Pausing for breath is how one market participant said it. Now, the focus, of course, is not only on that, because things could move very quickly, but the focus is on pound after we saw a bit of bullishness on pound sterling because of the efforts of vaccinating quickly. So the investor frenzy definitely that stoked wild gains in GameStop to silver showing signs of fatigue. What is instead is optimism about possible, for example, possible stimulus that's lifting the market overall. Now, coming up, Moonpig shares. Do you remember those? The cute little cards you can do online. Shares surging as much as 29% in their London trading debut. This is Bloomberg.
another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacquet here in London. Now let's take a look at the stocks on the move in Europe this morning, including Moonpig surging on its trading debut. Here's Danny Berger. Danny, I keep on hearing the sound of the Moonpig ad from like 10 years ago.
Yeah, it's really hard to get out of your head. Yeah. And the thing is it's clearly still relevant considering Moonpig rallying 23% on its IPO. I mean, it shows what a good environment it is, especially if you're like Moonpig and you're a company that does well in a pandemic. That is a greeting card gift company that you'd be sending people versus celebrating in person. So now, right now at 430 pence, IPO'd around 350. Airbus is the biggest gainer, though, on the stock 600 today, up nearly 6.5%. This is back to the old classical sell side action here, with Morgan Stanley upgrading Airbus, basically saying that they recently gave some projections in terms of building out more airplanes. Well, Morgan Stanley says that they actually have room to produce even more. So that's got the street excited today. Finally, BP, one of the big decliners today, down about 3%, issuing their earnings today, a miss for a lot of their 4Q statistics, including things like weak trading, weak oil and gas. And really the issue here is the thought had been more optimistic for these types of oil companies, that commodities had come back, but the pain for BP down nearly 3% just goes to show that the pandemic's effects are being long-lasting on big oil. Francine.
Danny, thank you so much. Danny Berger there with a roundup of the main stocks we're watching. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The U.S. has hit a new milestone in its vaccine rollout. More Americans have now received the jab than have tested positive for COVID-19. As of yesterday afternoon, 26.5 million Americans have taken one or both doses. That's just slightly higher than the 26.3 million who have tested positive for the disease. The U.S. is giving about 1.3 million doses a day. President Joe Biden says the U.S. could reinstate sanctions on Myanmar if the military doesn't give up power. It seized control in a coup yesterday morning, detaining government officials, including the country's de facto leader, Aung San Suu Kyi. The U.S. is calling for their release, saying any moves away from democracy will result in new restrictions. And New York and northeastern U.S. are facing their heaviest snowstorm for the winter so far. While the brunt of the storm is easing, it's expected to drop several more inches overnight. If the forecast holds, the storm will earn a spot in the top 10 worst storms to hit New York City, and data going back as far as 1869. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Now, the investor frenzy that drove wild gains in everything from GameStop to silver looks like it could be showing signs of fatigue. The metal is lower today, dropping from an 8-year high after margin requirements were raised and analysts cautioned against chasing the rally. Now, we've been asking our guests what they make of the market moves these past few days.
The reason it's all happening is because there is a lot of cash out there moving.
I assume hedge funds are probably reluctant to short small cap stocks right now for the fear that the Reddit brigade might be behind those.
Not really much was done wrong here.
I want to do whatever we can do to help the retail investors.
The investor that gets caught in the updraft on that and doesn't understand that investing, while it looks like it's all going up, you've just told me that they're down 34% today. Did the person who clicked the last buy understand that that could happen to them that quickly?
Investing is buying assets that generate income, that provide dividends,
that produce profits and appreciate in value over time. And, you know, long-term investors have the benefit of those returns compounding. When you're speculating, you're in essence buying a lottery ticket.
I like to think that under the new administration, there's more social utility, there's more enforcement.
Because of these small pockets of volatility, we think that the markets probably in the near term will continue to be quite worried and concerned about it.
Well, joining us now to talk about the markets and volatility is Kokou Agbo-Bloua, a global head of economics, cross-asset and quant research at Societe Generale. Kokou, thank you so much for joining us. When you look at the market over the last 10 days, I mean, it's been pretty crazy as we really try and figure out the repercussions and what happens next. And there are like a million angles that we could talk about. You know, has it had an impact on how you see the markets overall?
Absolutely. I think this is something that was, again, quite unprecedented. I mean, we've seen a lot of known unknowns and one in a century type moves over the past year or so. But I think this is part of sort of booms and bust cycles that we've seen in the past. So in 2015, for example, with the Chinese A shares. And I think this also will come to pass because typically when stocks do rally like this and you have a lot of retail investors making money quickly, obviously this leads to profit taking and mean reversion. And when you have losses being inflicted on sort of small investors, the marginal propensity to buy more obviously disappears very quickly, and then people move on to something else. So I suspect that this sort of trend clearly creates dislocation and distortions, but I am very skeptical on its ability to be sustained over the medium term.
Kokou, I guess in the shorter term, right, before that medium term where you see a kind of abating, do you see the I don't know whether you call it frenzy, but, you know, retail investors trying to get a leg up on Wall Street continue? Can they target other names? Or can they actually target, you know, things like silver? Could it go to oil?
I don't think so because, I mean, whilst in a particular stock, it's easy to identify short interest, and the institution who was short obviously is going to cover their short to avoid massive losses because in theory, you know, these losses could be quite significant. When you go into bigger, more established markets, I think it's very difficult to corner a market in the same way and magnitude. And also there's another important point is that for $1 bought by a retail investor, there was obviously other institutional investors that were trying to either front run or take advantage of this dislocation. And then you also have algorithmic trading and systematic strategies that will look for momentums and target the stocks. So it creates a snowball effect. But, you know, once people are aware of these trends, I don't think it will create the same amount of surprise and take this sort of panic buying as it did in the first round with the first few stocks that got short squeezed.
Kokou, just for the record, you don't see anything systemic?
No, I think it's absolutely not, because I think that the market is clearly has gone through these sort of excitement and distortions in the past, but ultimately these forces balance out, and the institutional investors typically will adjust their portfolio to avoid being taken off guard, and I think this is what's already starting to occur.
So, Kokou, when the markets, you know, stabilize a little bit, or we go to something that is considered a bit more normal, I'm not sure what normal is anymore, do we focus back on inflation? What do you think will be the main driver? Is it valuations? And is there a link to inflation, or do we ignore inflation expectations and just, you know, focus on the trends accelerated by the pandemic?
Well, it's a good question. I think there's a couple of things. I think inflation and inflation expectation have been going up, and this is pretty much the part of the central banks and the Fed in particular, who said that they were happy to let inflation move above their 2% target. And I think this is the exit strategy. There's been so much leverage by governments, by corporates, that the system has been looking to create and engineer inflation to effectively deal with this massive amount of debt. And the second very interesting theme is really this green transition and climate transition agenda by the Biden administration with, the 1.9 trillion plan. And same thing in Europe, same thing in China. And this is creating a new source of growth for companies from materials, commodities, electric utilities, etc. And this is where we are seeing real allocation of cash and capital. And this is something that could be a mega trend over the next few months to years.
Coco, thanks so much. Coco Agbo-Bloua there from Societe Generale stays with us, and we'll talk a lot more about the correlation between vaccine delivery and the recovery. Now, coming up, Angela Merkel promises all Germans a first shot of a COVID vaccine by the end of September. EU nations remain, though, far behind the US and the UK in terms of vaccine rollout. We'll bring you the very latest on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg business flash. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. Deutsche Bank is beating Wall Street with a 20% jump in debt trading. That's double the average increase of 10% at Wall Street's 5 biggest banks. Bloomberg sources say the German lenders traders raked in 1.4 billion euros in the final quarter of last year, as CEO Christian Saving leans on the unit to drive growth. The pandemic is hitting oil giant BP with its fourth quarter results falling short of expectations. It managed to eke out a modest profit, but it was just a fraction of what it made before the pandemic. Refining weighed down the company's performance, but CEO Bernard Looney is predicting better days in 2021. And Siemens Energy is cutting 7,800 jobs, roughly a sixth of its gas and power division. It's the latest sign that the worldwide shift to green energy is upending the fossil fuel business. The firm plans to eliminate the jobs by the end of the 2025 financial year. It includes 3,000 positions in Germany and about half as many in the US. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now let's get the latest on the EU's vaccine rollout. Chancellor Angela Merkel has promised all Germans a first shot of a COVID vaccine by the end of September. That's as long as drug makers stick to their delivery commitments, the Chancellor says. Meanwhile, the Commission President, Ursula von der Leyen, tried to deflect blame for a controversial plan to control vaccine exports with border controls on the island of Ireland. She said trade chiefs Valdis Dombrovskis had been responsible for the decision. Well, joining us now from Brussels is our Maria Tadeo. First of all, Maria, good morning to you. So Ursula von der Leyen facing her biggest crisis yet. I mean, do people believe it when she says, well, look, it wasn't really me, it was someone else's, or does it just make her look worse?
Well, they don't, and it makes her look worse, and that's the problem for Ursula von der Leyen. And you could say that this is almost a perfect storm that's hidden her this week. A lot of this is not new, Francine. You know, there's been criticism that her communication style is problematic. You know, this is someone who's very controlling about the way she comes across, but in a way that perhaps doesn't help her. It hinders her because it makes her look very detached from everyone else. There's also been criticism, and again, this is not new, that she is still looking at European politics from a very German perspective. And then now, of course, that reference that you mentioned there to Valdis Dombrovskis, who is a trade commissioner, who is, well, a friend of the show and is someone who's very, very well respected and very well regarded in Brussels. A comment that was made not by von der Leyen, but her spokesman yesterday, almost deflecting the blame, saying this was an issue with the Irish border that was problematic. We recognize that, but it didn't come from the president. It was an issue from DG Trade. That's the department that looks at trade for the European Union. Also made her look worse. This idea that ultimately it's the president that should take responsibility here for good and the bad. It really comes down to von der Leyen, and it's almost like she's deflecting this on the health commissioner, on the trade commissioner, and we haven't really heard from her today. She's trying to remedy that in a series of interviews across the European papers, but again, you know, she's defending the management of the vaccination rollout, she's defending her reputation, and there's also a really interesting line, Francine, in which she says, if you want to judge me, wait until the end of my term as Commission President. In politics, there's ups and downs, wait until I'm done. So there was any question as to whether or not von der Leyen was intended to leave or was even considering that, well, she's clearly not.
All right. I mean, Maria, I guess, you know, it's all forgotten if she achieves the vaccination target, and is 70% vaccination target by the deadline set out achievable?
Well, Francine, if you look at the number now and you look at the way that Europeans are vaccinating and the problems that we've had with Pfizer, the problems that we've had with AstraZeneca, it's clear that that 70% would not be achieved by the summer. You're looking at just a few months away from now. But Ursula von der Leyen and the Commission itself, too, they're clinging to this number because they believe it's still obtainable and it's achievable, and everything will make her fall on the 70%. If she gets there, all of this, everything around the AstraZeneca fallout will be forgiven. Now, what they say is that they will scale up, they will max out, and then also they point to rivals or labs, I would say they're a rival, but they're joining now forces to scale up their production. So they do believe that it's obtainable, and if you get to 70%, then all of this will be to some extent forgiven and forgotten, and Ursula von der Leyen could say, in the end, it did work.
Thank you so much. Our Maria Tadeo there in Brussels with the very latest. Now, still with us is Kokou Agbo-Bloua from Société Générale. Kokou, when you look at, first of all, this vaccination spat, I mean, longer term, does it actually have an impact on how citizens view the European Union? And is this going to play out in, you know, possible Frexit, Telexit, or is it just noise at the moment that will be fixed once people have the vaccines?
I think, yeah, this is an excellent point. I think it's very significant that the European Union gets it right. To use the quote from F.D. Roosevelt in his 1933 inaugural address, he said, "There's nothing to fear but fear itself." And the vaccine has clearly been sort of this light at the end of the tunnel, creating confidence and hope. And particularly when you look at financial markets, you know, the liquidity by central banks and fiscal authorities has acted as a bridge between bridging the gap between the short-term horrendous reality of the deaths and hardship and the end game. But obviously, there is always light at the end of the tunnel. It's important to make sure it's not an oncoming train. And if the vaccination process gets impaired, the credibility of the whole Eurozone and the governments and the confidence destruction that it could entail could be quite dramatic for the economy.
Gogo, what does it mean for, you know, the way that markets are actually pricing it? I know there's light at the end of the tunnel, as you put it, but is there a danger that actually these vaccines will be very short-limited, so that we're pinning all of our recovery on how quickly you get people vaccinated, and then 3 months down the line, you know, there are new strains that maybe the vaccines won't be able to combat, or we need to get vaccinated again because it's very short-lasting?
Yeah, clearly this is the tail risk scenario of a never-ending loop of a vaccine and a virus battle, if you will, through Darwinism, a natural selection. But I think this is why time is of the essence. And so far, all those strains are still can be cured or treated and prevented from expanding with the current vaccine and the current technology. But I think what's interesting is the logistical infrastructure that is being put in place where the vaccination is going quite exponential. So even if you had a new strain that was resistant to the current vaccine, it is possible to envision the situation where a new vaccine can be created within a couple months, and then the distribution this time will be a lot more effective than the first time around.
Koku, very quickly, are you expecting inflation in 2021 to surprise markets?
I think inflation expectation might go higher, but realized inflation, short-term, what we go through, shorter term might bounce back, but it's only to be sustained because the output gap, unemployment rate are still pretty high. So short-term inflation, I don't think it's a concern, but inflation in 5 years' time probably will.
Koku, thanks so much. Koku Abo-Blua there, Global Head of Economics, Cross-Asset and Quant Research at Societe Generale. Now coming up, Deutsche Bank's debt trading jump beats Wall Street. More on the numbers next. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, this is what the market is looking at, or at least positioned as. Global stocks actually climbing on renewed hopes for stimulus. So let's bring the board up so that we get a full market check. There seems to be progress on vaccinations. And of course, there also seems to be receding concerns about volatile retail trading. Silver pulling back from an 8-year high. And then the other thing I'm watching out for is, of course, pound. There was a bit of move on pound after, if by any metric, the UK is doing really well in terms of vaccine rollout, and there was a bit of lift once again to sterling 136.93. Now, Deutsche Bank beating Wall Street with a 20% jump on debt trading. That's double the average increase of 10% of Wall Street's 5 biggest banks. Now, Bloomberg sources say the German lender's traders raked in 1.4 billion euros in the final quarter of last year as chief executive Christian Sewing leans on the unit to drive growth. Now, for more, we're joined by Bloomberg's reporter Steve Ahrens. Stephen, first of all, this is a great Bloomberg scoop. You spoke to sources, and thank you so much for bringing it also on TV. What do you make of what that means for what Christian Sewing will focus on next?
Hey, thanks, Francine. So, yeah, I think it's a big boost for Christian Sewing. As you just said, he's staking his turnaround effort on the debt trading unit. And if he can continue to show market share gains, then that validates his claim that the unit has turned a corner and is improving performance. So, yeah, I think it's really important for him.
Stephen, does it mean that, does it have an implication for cost cuts? Does it actually have an implication for the overall strategy going forward?
It's a good question. I mean, you would think, right, if the debt trading unit is so successful that they would probably hire people there, even though they have a very, very high job cuts target. However, they've said on the record that they don't really want to throw more resources at the unit. They're trying to make more money with what's already there. So I don't think so. But yeah, I mean, if revenue continues to grow more than they expect, then of course, I guess that opens up possibilities to cut costs even less. But that's not a plan at the present.
So what else are we expecting from earnings later this week, Stephen?
So debt trading, obviously, that's going to be a big focus. Cost cutting continues to be a very strong focus at the bank. They've given themselves a target for the year for 2020, and we'll have to see if they manage to reach that or even exceeded that. They sort of guided they were going to do better than the target. And then they've said they want to reach a pre-tax profit for the year. They may even be a small net profit for the first time since 2014. So that's going to be another question people are going to ask on that day.
Stephen, thank you so much. Stephen Ahrens there with the very latest on Deutsche Bank. Now let's take a look at some of the other things we're watching out for today. In Russia, a court hearing is scheduled for Russian opposition leader Alexei Navalny, who faces a prison term of as long as 3.5 years. That comes as EU Foreign Policy Chief Joseph Borrell travels to meet with his opposite number. And then in a few minutes' time, we'll also get an update on the euro area economy. Well, upside surprises to national figures point to a much milder hit to GDP of around 0.4%. Later today, watch out also for fourth quarter numbers from U.S. tech giants Amazon and Alphabet. Well, Bloomberg Surveillance continues in the next hour. Tom Keene joins me out of New York. We'll look at the markets, we'll look at silver futures, we'll also look at pound. This is Bloomberg.
day of risk off across the financial markets, we bring you special coverage of all the price action and implications here on Bloomberg Television. Short interest in GameStop plummets, and so do shares. The silver rally also runs into a roadblock for now. BP earnings fall short. COVID hits the oil majors' fuel sales and margins. The chief executive tells us that investors are supportive of the company's energy transition strategy. And Deutsche Bank's debt trading jump outpaces Wall Street. That's a Bloomberg scoop ahead of Thursday's results. Well, good morning, everyone. This is Bloomberg Surveillance. As always, Tom and Francine from London and New York. Tom, we look at silver, we look at GameStop, we also look at pound, because we spoke to Jane Foley yesterday, and that was the beginning of a bit more bullish bets on pound. And this, again, has everything to do with the vaccine rollout and how quickly the UK is doing it.
It's the first normal day in ages. I mean, we've got all these different story stocks rolling over. We'll cover that today. But Francine, you've got futures up big, up 33. We'll do the data check. But with it, bond yields up, and also the continuing saga out of Washington is the President's Day starts at 5 a.m. Wall Street time. Francine, what's that about? You know,
I was going to say, we have headlines dropping. I'm checking. It's 5 a.m. and the president likes to give news at 5 a.m., I guess, to start his day, and so that all news outlets are on the same page. Joe Biden is moving to restore the asylum system. The agencies will review some of the policies. And again, this just feels to me like a rollback on some of the things that President Trump had put in place. And he's also rolling back some of the migration orders and family separation that President Trump had put in place.
Francine, it is a rollback, but very, very importantly, in the three items I see, we see the idea of form a task force or do, as you mentioned, do a review. These are delicate issues, and this is not strident orders reversing what Mr. Trump did. It is the process of doing it, which is, of course, what President Biden's emphasized.
Right, and Tom, you would argue that actually, it's no good just reversing. It's, if you're going to reunite families, and there seems to be a clear want from this new administration to do so, you have to do it so that it works. If you just sign an order without a to-do list, then it gets you nowhere.
For our global audience, Francine, I would say that one thing I've learned at Bloomberg News for the 400 years I've worked here is this is the third rail of American politics, immigration, and the president traipses delicately here within these executive orders today.
Tom Keene with his glasses. Look at that, Tom. I'm going to wear the bow tie next, and then I'll be
but the difference is I have my glasses on, folks, because, I'm blind and I have to wear them. Francine has her glasses on because she was in Mortal Kombat with her children last night and got hit over the head by a Tyrannosaurus Rex.
Yeah, it's just the eye. Actually, I think it was the tail, and it hit my eye. So there you go.
You okay?
Onwards, Tom. Well, that's perfectly. Let's get straight. I can read prompt, which is the only important
thing.
Let's get straight to the Bloomberg First Word News with Ritika Gupta. Hi, Ritika.
Hi, Francine, Tom. President Biden intends to keep pushing for a large pandemic relief bill, even if he has to bypass Senate Republicans. The president and 10 GOP senators had what one lawmaker called a very productive meeting on stimulus options. A White House spokeswoman said there were areas of agreement, but also areas the Republican plan doesn't address. The president wants a package about 3 times as large as Republicans are offering. And President Biden will keep U.S. tariffs in place on aluminum imports from the United Arab Emirates. He's reversing a last-minute move by Donald Trump to grant the UAE relief from the duties. The president says the evidence indicates that imports from the UAE may still displace domestic aluminum production. And it's an early milestone in the race to end the pandemic. More Americans have received at least one dose of the coronavirus vaccine than have tested positive for the virus. As of yesterday afternoon, 26.5 million Americans had gotten one or both doses. The U.S. has been administering shots at a faster daily rate than any country in the world. And silver's rally to an 8-year high has lost momentum. A key exchange raised margins and warnings about the surge increased. Silver emerged as the latest focus for investors on Reddit's Wall Street Bets forum. A buying stampede followed, but now there are doubts over the lasting influence of that investor army. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom.
Ritika, thanks so much. Let me do a regular data check. We'll get to GameStop, silver, and all that. GameStop down, and it's supported at $89. We're not there yet. Futures 2 days in a row advanced sprightly. 3,800 on SPX is a big deal as well. The VIX comes in. What were we? 30.31 yesterday. We're in three big figures, 27.16. And here's the key thing, Francine. Yield confirms. That's the first time I've said that in at least a week, if not 10 days, with a 1.10 on the 10-year yield. And when you look at the nominal yield, 1.10, and you look at the real yield coming in with a vengeance to a negative 0.99, that tells you inflation expectations elevate over the last 48 hours. Francine?
Tom, I love that. It's a new benchmark. I haven't said that in 7 days, or maybe 10. That's, setting the new trend. Global stocks climbing on renewed hopes for stimulus, progress on vaccination, and receding concerns about volatile retail trading. That's giving a little bit of lift to the market, and silver pulled back from an 8-year high. Are there dinosaur futures? Actually, my 6-year-old would cry, Tom, if we said that dinosaurs don't exist, so I hope he's not watching.
Oh, no, they do exist. Yes, they do. They're out there.
Now, the retail investing drama continues to captivate Wall Street and Washington.
The reason it's all happening is because there is a lot of cash out there moving.
I assume hedge funds are probably reluctant to short small cap stocks right now for the fear that the Reddit brigade might be behind those.
Not really much was done wrong here.
I want to do whatever we can do to help the retail investors.
The investor that gets caught in the updraft on that and doesn't understand that investing, while it looks like it's all going up, you've just told me that they're down 34% today. Did the person who clicked the last buy understand that could happen to them that quickly?
Investing is buying assets that generate income, that provide dividends, that produce profits and appreciate in value over time. And, long-term investors have the benefit of those returns compounding. When you're speculating, you're in essence buying a lottery ticket.
I like to think that under the new administration, there's more social utility, there's more enforcement.
Because of these small pockets of volatility, we think that the markets probably in the near term will continue to be quite worried and concerned about it.
Well, joining us now is James Bevan, CCLA Investment Management Chief Investment Officer. We're also getting just a little bit data out of the Eurozone, which seems a bit better than expected. But James, if we go back to the big story of the last 10 days, GameStop, and then we saw what's happening with silver. Can this happen again and again, or will short sellers, take precautions?
Well, I say that there were three rather separate issues at stake. First off, GameStop was the natural target for the short sellers because its fundamentals have been deteriorating for years, and this challenge of excess liquidity in the market clearly was encouraged by social media, suggesting that there would be outsized gains on the back of short closing. And I would certainly expect that we should see more examples where people attempt to crowd in stories with a lot of shorts to get those shorts squeezed, to get the price up. The problem that one has with all of these stories, of course, is that it's the last man standing. It's rather like a game of musical chairs, and it's fine, as with the South Sea bubble, to buy and then sell at a higher level. But the person who buys at the top does have a very difficult time because the fundamentals are materially below even the current prevailing share price. In the case of GameStop, the sell side has a range of estimates of fair value between $3 and $33. So the downside risks are very significant. That said, at least there is an ongoing business that underpins the value of GameStop. I would say that is absolutely not the case with the cryptocurrencies, where I think the fall from grace could be much nastier and much harder.
Let me frame right now where we are with GameStop, folks, for this morning as well. The chart that we've got is 5 days up on GameStop, and it's a little, there it is, that's a better chart. They're up to $500 a share and down. I'm going to call modest technical support over, say, 7 days at 200, maybe 190 per share. Here's the headline. We've broken that this morning, and the next support I calculate from January 24 to 26 is about $90 per share. So the breakthrough here would be painful, to say the least. James Bevan, it's a great, a moment, another short squeeze. You and I have seen these. You and I have studied these as well. What will be the modern lesson learned here, given technology, given what Robinhood has wrought?
I would say that the single biggest lesson we should all learn is that in periods of excess credit, liquidity, and boundless enthusiasm, there will be many bubbles forming in markets. And I would say that the price of GameStop is in part to do with the short squeeze, but it's also to do with the huge optimism that people are now displaying towards stories that may or may not come good. But this is a market where the optimism is now a key driver of what's happening.
Okay, James, you and I remember when an IPO came and you made 6% net clean. You remember Mack Truck bids on municipal bonds and bonds as well. That Mack Truck, folks, is a field goal, 3 points you'd make. Okay, those days are over. James Bevan, the free lunch of free commissions is the heart of the matter here. And then the massive liquidity that is required to make this modern machine go. Can that modern machine extend into the future, or will it be regulated away?
I think that there is every chance that the global liquidity and credit tide continues because central banks absolutely are nervous of pulling the rug from underneath markets, creating significant market challenges with real economy.
Okay, guys. Morning, everybody. If you're looking to sell short euro, it's time. Let's try, because the price I'm looking to sell 120.71. Let's see if I'll be able to sell at this price. Even 120, yeah, 120.71. Okay, let's see if I'll be able to sell at this price.
No, I think that in all market conditions where there is a high degree of credit availability, liquidity, and optimism, we should expect this to continue. It was very much the case with tulip mania in Holland, with the South Sea bubble, and all of these speculative crises that we have observed have always involved retail investors piling in on the back of cheap money.
All right, James, thank you so much. James Bevan there of CCLA Investment Management stays with us. Now, coming up, we also speak with Jeffrey Curry, Goldman Sachs Global Head of Commodities Research. I know he has a thing or two to say about gold and silver. That's at 5:30 a.m. in New York, 10:30 a.m. in London, and this is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, building.
Okay, if you're looking to buy British pound, I am going to place an order to buy pound at, oh, it went down. Let's see, let's wait. No, the order cancelled. Let's wait for another time. Move down.
Bloomberg Surveillance. Good morning, everyone. Francine Lacroix in London. I'm Tom Key, New York. Lots going on. We are covering the rollover of silver, the rollover of GameStop as well. Been talking to James Bevan about that with CCLA, but
I have to cancel order to sell short euro. As you can see, it's moved really, really seriously down. So basically, I need to wait for another chance to place an order. When momentum will change, direction of this pair will show me which way it will go.
How do you find those companies?
Tom, I think that structural growth stories with decent cash flow are surprisingly easy to find if one thinks about what the future of the world looks like, if one can find a reasonable balance sheet and one can observe a fundamentally profitable business as of today, one tucks those stocks away in a diversified portfolio, I think that one will make decent money. The big challenge, I suspect, for investors, however, is to determine how much they are prepared to play with leverage. You raise the expectation that companies like Amazon and Alphabet have served their investors well, but when I look at the relative performance of Alphabet and Domino's Pizza, for example, I would observe that Domino's has done well on the back of buying in its shares and raising its leverage. Now, we all know that means more risk. For the near-term, shareholders have benefited very substantially. In contrast, Alphabet and Amazon obviously focused on maintaining lots of cash and a strong balance sheet.
Right.
Me, the tech stories continue to benefit, but in a world of leverage, they are not going to outperform companies that acquire the market's imagination.
James Bevan, the distinction here between the financial engineering that has been stated of General Electric or of International Business Machines is compared to Apple. Yesterday, Apple with a $14 billion six-tranche bond offering, clearly to buy back shares. That's the zeitgeist on it. But James Bevan, how do you determine an Apple in their manipulation of share count versus other companies such as International Business Machines?
Tom, I would draw a significant difference between companies who have ample free cash flow and can sensibly manage their balance sheets, may decide that returning value to shareholders via buybacks is better than paying dividends. And therefore, people who bought Apple shares have obviously not been receiving dividends they might otherwise have had, but have had buybacks to add value. In contrast, when I look at companies issuing debt, buyback shares where free cash flow is poor, I see a future accident waiting to happen.
Tom, do you know what Moonpig is?
No.
You kind of go online. Okay, so Moonpig IPO'd today. You kind of go on, I'm Stationary Queen, and I don't really use it, but you go online and then, you know, you send a nice card to someone and you personalize it via Moonpig. Today it IPO'd, and James, we're well, you know, above what we were expecting for Moonpig. I mean, what are all these new IPOs? Do you buy into any of them, or is it just too frothy?
Moonpig.
I think there's a huge amount of froth in the IPO market at the moment, and particularly I would observe that the quoted markets still have plenty of headroom if bond yields stay low and inflation does not accelerate. I believe that for the equity risk premium for the S&P 500 is still up at 700 basis points, 7%. I think that fair value is much closer to 5%. On that basis, I think that the S&P 500 can reach 4,300 points by the end of the year. Now, on that basis, I don't want to take risks on IPOs that look frothy.
Okay, what doesn't look frothy? I mean, it seems that everything that has a .com or digital component is getting overbought.
There's a lot of momentum behind those names, but I would say that there are plenty of other names, particularly companies that are linked to the outlook for inflation. So over here in the UK, I would be looking at companies like BT and some of the utility companies that have underperformed since last March, but where their revenue streams are linked to inflation. I would look at CK Infrastructure as a global play that looks extraordinarily well placed in the States. I think that Bank of America has been overlooked. Believe its revenue streams will pick up as inflation accelerates. I think its balance sheet is secure.
James, when you look at, the market seems to be tracking the vaccination efforts. Like the UK is doing quite well, and you're seeing it in pound because the UK government is quite fast at getting people vaccinated. Is this a misnomer? Is there a concern that actually 3 months from now, we turn around and think actually there are strains that the vaccines don't combat? Actually, after 3 months, we need to get vaccinated again.
Well, I think that the tide has turned in the fight against COVID-19, and that I would make a bold prediction by the end of the year, COVID-19 will be much less of a concern than it is today. So it will not be a straight line, but the direction of travel is undoubtedly optimistic. The bigger challenge, I think, relates to the fact that undoubtedly the global economy took a significant and sustained hit on the back of the COVID-19 and the related restrictions, and whatever happens with credit and liquidity are not going to get an economic bounce, justify some of the optimism that is playing out in markets. Now, I think that central banks and governments can keep both afloat as long as they are prepared to spend money and to print money. That said, there is clearly an inflation risk in due course, and I worry that inflation is under-considered by most investors, and the challenge must be at what point do central banks determine they need to pull the punch bowl away.
James Bevan, thank you so much. Greatly appreciate it with CCLA Investments today. We've got lots more coming up, folks. Markets really on a move, and I really want to underscore the lift in yields that correlates in with this equity lift. Futures up 32, the 10-year yield 1.10% gets my attention. This is timely. David Miliband of the International Rescue Committee, their Chief Executive Officer, in the 12 noon hour today. Stay with us. This is Bloomberg. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Ritika Gupta with the Bloomberg Business Flash. BP showed that big oil is still suffering from last year's historic slump. The British energy giant posted earnings that were worse than expected on weak fuel sales, refining margins, and gas trading. Profits declined 96% from a year ago. BP CEO Bernard Looney predicts better days this year. And bears appear to have started covering their GameStop positions in earnest. Short interest in the video game retailer fell to about 39% of free-floating shares. That's down from 114% in mid-January. GameStop lost nearly a third of its value yesterday after soaring 1,600% in January. The short interest promoted hordes of day traders to pile into the shares. And meanwhile, the biggest backers of Robinhood are putting money into the beleaguered online brokerage at a record pace. Investors led by Ribbit Capital poured $2.4 billion in the firm yesterday. The cash infusions comes as Robinhood grapples with outraged customers, increased scrutiny from Washington, and questions about plans for an IPO. And that is the Bloomberg Business Flash, Tom.
Ritika, thanks so much. Equities, bonds, currencies, commodities. SPX at 3,800 level gets my attention. Not a record high, but getting there rapidly, up 237 Dow points in three big figures on the VIX, 27.26. And the most important thing is yield correlates here, 1.10. We've gone from a 0.99 to a 1.10 in what, 5, 6, 7 days? That gets my attention as well. Gold, 1849. Francine?
Yeah, Tom, looking at global stocks, look, they're climbing, especially on renewed hopes for a stimulus. Up next, the Jeffrey Curry, Goldman Sachs Global Head of Commodities. We talk silver. This is Bloomberg.
一个就是我们看中它的那个品牌吧，它品牌就是说东西比较干净嘛，然后比较方便的话，味道也还可以的话，我觉得我会考虑吧。外卖的话呢，也是一种方式，就是品种会多一点嘛，各有它的特点吧。
这个车的话，目前我们是通过这个手机 APP 上，就手机扫码，然后微信和这个支付宝扫我们这个车上的这个二维码，大家就会进入到一个小程序的这个界面，然后呢就可以选购自己喜欢的商品，然后付款之后呢，这个柜门会自动打开。
支付成功，请拉开右侧车门取货并关紧柜门。
然后我们会取餐，然后完了之后呢，就把餐这个柜门关上，然后整个购买的这个流程就会结束。
柜门已打开，请取出货物并关好柜门。
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London, Tom Keene in New York. Tom, silver. We've been talking about nothing else in silver all week. We're retreating today from an 8-year high with the Reddit-fueled retail frenzy showing signs of fatigue. Well, joining us now to talk about the global commodities market, talk about gold, oil, and silver, Jeffrey Curry, Goldman Sachs Global Head of Commodities. Jeffrey, thank you so much for coming on. I don't know whether the parallels, right, between GameStop and some of the Reddit action can really directly transfer to silver, because it's a different market. And actually the positions from a lot of the hedge funds were completely different.
Well, I think when we look at the silver market, the one thing to keep in mind, it is a lot larger than these equity markets. You put the total amount of open interest of silver, including both above ground and below ground, somewhere in that $200 billion range on an annual output basis. That is substantially larger. And as a result, to corner the market and create a short squeeze, we estimate it require each one of these Wall Street individuals to accumulate positions of somewhere around 4,200 ounces. That's a lot of silver, and where are you going to put it? So the analogy to, let's say, the Hunt brothers or, Thursday, Silver Thursday, I think, are far stretched. And also, let's not forget, because of the Hunt brothers squeeze back in 1980, there are regulatory policies put in place that prevent a replication of that, i.e. position limits. So to see a similar type of dynamic take place in a macro market, we see it as extremely unlikely.
So, Jeff, what are you expecting silver to go from here until the end of the year?
Our target is $30 an ounce, really being driven by a combination of a stronger gold market, as well as the solar panel demand, or call it the green capex, driving prices. Now, we do expect, if you see the Biden administration approve its solar ambitions, that target would move to $33 an ounce. Now, given the market's trading in that, $27, $28 an ounce, it means there's a real fundamental story here. We like silver. However, we don't like it because of a short squeeze. We like it because of the fundamental story behind it.
Jeff Curry, you were mentioning as we went into this interview about Jennings Bryan, 1896, and the cross of gold. Let's talk about the cross of silver right now, which is the fixation of the public on trading commodities versus the fundamental story around tangible assets. You've always weighted the fundamental story. Is that a dated view? Do you have to shift and be more supple in your thinking about the speculative market of tangible assets?
Well, when we think about the fundamental story of commodities in real assets more broadly, part of the reason we never saw a commodity bull market over the last, let's say, 12 to 15 years is because we never saw significant demand for commodities. What we think that these populist movements are likely to do is create an environment in which governments start spending, particularly on lower income households, that will create that demand for commodities and goods more broadly and create a more cyclical, commodity intensive economic backdrop. And that really sits at the core of our bullish view on commodities as we see REV policies, redistributional policies, environmental policies like environmental capex, and versatility in supply chains. And these things are very much related. I think I can use green leveling, spending on green capex to level income. These types of expenditure programs are really going to be behind our bullish view on commodities.
Your bullish view on commodities has been noted. There's some people pushing against you, Jeff Curry. It seems like it's just guarded, and you're out 2 standard deviations through the trend. It's a really remarkable breakout of the long-term resistance that we've seen. Reaffirm the magnitude of the movement you believe we will see.
Yeah, I would put it on par to the bull market we saw in the 70s or the bull market we saw in the 2000s. I would say this is more akin to what we saw in the 70s to the 2000s. Why? Our redistributional policies back then were the Great Society, the war on poverty. RE, environmental policies. You had the war on acid rain, Clean Air Act. You had the Clean Water Acts. Lots of spending on environmental policy back then. And then our V, our versatility in supply chains or resiliency in supply chains. Then you had the Cold War with Russia. Now we have a quasi-Cold War with China that can require spending. In fact, the big move in agriculture that we have seen over the last week is buying by the Chinese. They're building strategic reserves of grains, very similar to what the U.S. and Europeans did back in the 70s when they built their strategic reserves. So, the analogy here and the magnitude is probably something more similar to the super cycle of the 70s than the one of the 2000s.
Jeff, going back to the silver trade, do you see the potential for retail traders to actually break into natural gas or oil?
Again, the size of these markets, they're extremely large. They can break in it and they trade it, and they have been a part of these markets. You have the ETFs in natural gas, you have the ETFs in oil, which are very large. And you do see an active presence of retail participation in those markets. However, I think what is different about this is the idea that they could drive these markets and push them. And they did drive and push silver yesterday. But when you start to get to markets like oil and natural gas, the liquidity is substantially larger and it becomes that much more difficult to do. So there's a question here, participation. Yes, they are participating. Yes, they are a part of these markets. But to be the marginal driver of these markets like they were in silver yesterday is, a much larger question mark.
Jeffrey, is there an instrument, though, that could, if that's what they decided to do, would they play it through ETFs, or is there an instrument that would make it easier of access?
The ETF is the easiest access. Now, one thing I want to point out that makes oil radically different than silver or gold, the ETF in silver and gold is physically backed. In fact, that short that the retail investors were focused on in the COMEX market is the hedging of that physical position in the ETF. The ETF in natural gas and oil is nothing other than a rolling front month GSCI style contract. It is a paper position, it's not a physical position. To understand why, I like to make this simple example. You can take all of the ETF physical position in gold and put it in your office. It may break the floor, it's so heavy as it would fall through, however you could fit it in its office. And then let's think about this. The ETF position in oil, if you were to hold it in a physical position, it would require something like 70 or 90 VLCCs. Now imagine in your head parking 90 VLCCs in the East River in New York or the Thames here in London. It would be pretty difficult.
Jeffrey, thank you so much. Jeffrey Curry there of Goldman Sachs stays with us. Now let's get straight to the Bloomberg First Word News. Here's Ritika Gupta. Hi, Ritika.
Hi, Francine. President Biden and Republican senators have agreed to keep negotiating a bipartisan coronavirus relief package. But the president made it clear he'll keep pushing for a large relief measure, even if he has to bypass the Republicans. President Biden wants about 3 times as much in the bill as the Republicans are offering. And Senate Republican leader Mitch McConnell has waded into the intra-party fight over GOP Representative Marjorie Taylor Greene. McConnell didn't mention her by name, but he denounced what he called her loony lies and conspiracy theories. House Democrats are threatening to punish Greene if Republican officials don't take action over her past incendiary remarks and social media posts. Here in New York, we're being hammered by a snowstorm that could become one of the worst in the region's history. Forecasters say the worst is over. Still, the city could end up getting as much as 20 inches of snow. Rail and air service is at a standstill, and roads are impassable at points. And Chancellor Angela Merkel has promised all Germans a coronavirus vaccine by the end of September. That's as long as drug makers stick to their delivery commitments. Merkel has come under fire after pushing for the European Union to take the lead on vaccine purchasing. Critics say that delegating responsibility to the EU has slowed down national inoculation programs. Global News 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom.
Ritika, thanks so much. Futures up 35. We come in 3 big figures on a more than bull market, 27.15 now on the VIX. This is more than a timely interview. David Weston with Harvey Pitt, the former chairman of the Securities Exchange Commission, yes, with Calorama Partners, well-timed. Harvey Pitt, the noon hour, balance of power. This is Bloomberg. Good morning. Bloomberg Surveillance. Good morning, everyone. Francine Lacroix in London. I'm Tom Keene in New York. We're getting a commodities brief from the gentleman from Goldman Sachs, Jeffrey Curry, with us. Let's look at a chart right now, and this is the long-term Bloomberg chart. The Goldman Sachs Commodity Index is more oil-weighted, and the Bloomberg Commodity Index is a little more blended out. It's been a long-term disinflation decline, however you want to phrase it. And there is now a breakout. Going back to that break after the China boom, we are well out over 2 standard deviations. It's the Curry call. on commodities. And Jeff Curry joins us right now. Jeff, so much of the bid and ask dynamic, particularly across a broader index, is the constraints of a market. It's the equilibrium as a smaller box. I'm doing my Chicago imitation here, Jeff Curry. How tight are those markets across different commodities?
When you look at the current environment, every single one of these markets is in a deficit with the exception of zinc and cocoa. That's extremely rare. You never see deficits across the board this early in a business cycle, and it's indicative of the supply constraints that all these markets are facing. We like to call it the revenge of the old economy. You don't invest in basic production capacity of your old economy, it does create supply constraints, and we're seeing the evidence of that. Yes, you're going to say, well, oil, that's being artificially constrained by OPEC. Yes, but they do it is because they know once demand rebounds, there's no competition.
But I'm going to assume, Jeff Curry, there isn't a copper cartel. Dr. Curry on Dr. Copper right now. And what's so important, Jeff Curry, is I would suggest going way back to my reading of commodities literally 40 years ago, people don't understand the constraints of, say, the copper market, that when it goes, it goes.
Mm-hmm. The reason why you get that is that these commodities are really important to global trade. And once they start to begin to go up, it increases global liquidity. You can see global liquidity is rising in every one of these central banks everywhere in the world as determined trades improve. That global liquidity then in turn gets lent out, creates more liquidity, more demand for commodities, a weaker US dollar, and you get that reflation feedback loop. That reflation feedback loop worked in the 70s, it worked in the 2000s, and it's turning again today.
Jeff, talk to me a little bit about how the Biden administration will actually, what it means for some of these trade concerns between China and the U.S. and therefore access to some of, for example, the raw materials, some of the materials that are needed to do components in our iPhones and the like.
Well, I mean, part of the reason why there is such a bid to some of these key commodities right now, China is stockpiling it. That's part of our REV thesis, REV. The V is versatility in supply chains, is China is building stockpiles of grains, to protect itself in terms of its supply chain for food, but also of metals, and particularly these key metals that go into their manufacturing and production supply chain. So this is a dynamic that's underway. And if you think about why they're doing this, the evidence between the trade war, COVID has demonstrated having resilient supply chains is critical going forward, and some of these metals are critical. But I'm going to ask a broader question is, we are out of copper. You look at the inventory draws over the first 5 weeks of this year, they're unprecedented. Inventory levels are back to 2008 levels, and we have not even started Biden's electrification or green ambitions. What happens when we try to do this? The upside potential in copper is massive.
Thank you so much for joining us, Jeffrey Curry. As always, Goldman Sachs Global Head of Commodities, just smart on commodities and everything in between. Now, coming up next, Sigve Brekke, the Telenor Chief Executive Officer, will be talking, of course, about earnings, but a lot more also on Burma and that coup in Myanmar. This is Bloomberg.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
Snabba, thank you so much for joining us. What was the biggest thing you've learned about what a leader needs to be?
Well, it's really an emotional, or it's about being authentic, about believing in the path you're taking.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. I'm Rishka Gupta with the Bloomberg Business Flash. Boeing is signaling that it is at risk of losing more than a third of the orders for its 777X jet. That's because the latest delay to the plane's debut gives some customers the right to walk away from sales contracts. Last week, the company said the 777X now won't take to the skies until 2023. The Pentagon is going to college to try to fix its most expensive weapons system. The Defense Department is tapping the expertise of 3 top universities, Johns Hopkins, Carnegie Mellon, and Georgia Tech. They're being asked to figure out what must be done to fix software problems on Lockheed Martin's F-35. The plane is a flying computer, and bulky software has been a nightmare. And Apple has taken advantage of cheap borrowing costs. It tapped the debt market for the 3rd time since May, selling $14 billion of bonds. The iPhone maker wants to return more cash to shareholders. Apple issued the debt in 6 parts, including 40-year bonds. And that is your Bloomberg Business Flash. I'm Francine.
Thank you so much, Ritika. Now, the Norwegian telecom company Telenor missed estimates in the 4th quarter. The carrier is one of the key phone operators also in Myanmar. Part of the mobile network is down due to a military coup over the weekend. Now, the region accounts for 6% of the sales. So we'll have plenty more, of course, on Telenor. I know, Tom, will delve deeper into the chief executive on, so if you break down some of the sales, so Myanmar is 6%, some of the other parts of the world, in Asia, certainly bigger than the proportion of some of the older carrier. So we'll have a look at exactly what that means for their growth going forward. Do we have a data check, Tom? Always a good thing looking at silver futures.
Yeah, I've got to lift up 37 right now. We have a further improvement in the market. And again, this is on a better yield structure, higher yields. It's almost back to a normal market. I'd really note VIX in nicely, 27.02. Francine?
Yeah, Telenor also actually on the rise, Tom, in today's trading session. We're delighted to be joined now by the Chief Executive, Sigve Brekke, who joins us. Mr. Brekke, thank you so much for being with us today. We need to start to talk about Myanmar. I believe that in recent weeks, you had to register some of the users. I don't know whether it's new users or some of the existing users, but overall, this was a big growth story for you. What do you make of the events in the last couple of days?
Yeah, thanks for having me. Let me start with saying that we entered the Myanmar market back in 2013, and we have been actually an important part of the opening up this market, the democratization process. So it's sad to see from that point of view what's now happening, and I really hope that they will find a solution. What we are focusing on right now is then to provide connectivity to all our customers. The network is running as normal, distribution is as normal, and all our employees are safe. So we are going to continue also in this critical phase to make sure that we are a part of continuing to deliver communication services. As you said, there has been a lot of changes in Myanmar last year. And this SIM registration process also created a change where people went from multiple SIM cards into more primary SIM cards. But we are one of the market leaders there, and we really hope that we will continue to be that.
Mr. Brekke, how does it change then how you view Myanmar going forward? Could it actually potentially, stunt your growth there significantly?
I think that's too early to say. The development in Myanmar has happened very fast. I'm thinking about the connectivity part of it. Most people now have a mobile phone and they are heavy data users. And I really hope that is to continue also with what recently happened. So, but it's too early for me to speculate on what may happen. The most important thing is that we stay focused now on delivering the services that our 20 million customers need.
Mr. Brecker, these are delicate issues, but certainly you and your technology are at the forefront of the expansion of some of these challenged countries, some of these smaller countries. As you mentioned, they're massive data users. Where is Telenor in Burma in 5 years or in other countries like it? Where do you see that use of data buttressed up against government shock in 5 years?
Well, what we have seen in all these markets, and as you may know, we are also operating in markets like Bangladesh, Pakistan, and Thailand and Malaysia. We see these markets already leapfrogging the digital age. So they are kind of going from nothing to being advanced data users in very, very short period of time. That's happening in Myanmar as well. So we see these customers now becoming more and more advanced data users. That's also why we see that the data ecosystem is being developed. Also local content providers to come into the markets. And where we see a real growth opportunity in that respect in all these emerging markets.
These nations each have their distinctive stories wrapped around democracy, the challenges of democracy, and the outcomes of a more autocratic sense. Do you suggest that these countries will limit social media, or do they use social media constructively over your products?
I think what we have seen in all these markets is that the time has passed beyond the ability for